Everyone is running to gold. Central banks are hoarding it. Influencers are selling it. Preppers are stacking it. But the Amish, they're not buying gold. And during inflation, recessions, banking crises, they quietly outperform most modern investors. No panic, no charts, no CNBC, just one simple hedge that has worked for 300 years. Tonight I'll show you why gold might not be the real safe haven anymore, and what the Amish understand about wealth that Wall Street doesn't. Stay with me, because this might change what you protect. Gold is emotional. Before it is financial, it is psychological. When fear rises, people don't search for productivity, they search for comfort. And gold feels like comfort. It shines. It is ancient. It survived Rome. It survived empires. It survived currency collapses. That story alone makes it powerful. But stories and protection are not always the same thing. Here's the uncomfortable truth. No one selling gold wants to emphasize gold preserves value inside a functioning exchange system. It does not create value on its own. That distinction matters more than most people realize. When inflation spikes, gold often rises. When currencies weaken, gold often strengthens. When central banks print, gold reacts. But notice something. Gold reacts. It responds to monetary instability. It does not solve instability. Not always pistos produce food. It doesn't generate energy. It doesn't repair infrastructure. It doesn't create shelter. It simply sits waiting for someone else to price it higher. In a world of working markets, that sits fine. But what happens when markets freeze? In 1933, Americans couldn't legally hold gold. In 1971, the gold standard vanished overnight. In 2008, liquidity evaporated across entire financial systems. Gold didn't stop the panic, it reflected it. And reflection is not the same as protection. Most investors buy gold because they fear paper assets. But gold itself is still dependent on market access, buyers, or liquidity, pricing mechanisms, financial infrastructure. If you can trade it easily, if markets are closed, if transportation halts, its utility changes dramatically. Now ask yourself something deeper. If tomorrow the stock exchange shut down, if banks limited withdrawals, if digital payments froze for a week, would gold solve your immediate problem, or would something else matter more? Food, fuel, land, water, community, skills. Gold protects purchasing power. But purchasing power only works when there is something available to purchase. And that is the flaw most investors never analyze. They hedge currency risk, but they ignore system risk. Currency risk says, the dollar weakens. System risk says, the system itself stops functioning normally. Gold is excellent for the first. It is limited for the second. That's why the Amish hedge is different. Because it doesn't depend on belief in a monetary framework. It depends on tangible output. Gold is a store of value. The Amish hedge is a source of value. And that difference, store versus source, is where real resilience begins. Most people chase assets that go up in price. Few people focus on assets that continue to work regardless of price. Gold's strength is psychological security. The Amish hedge's strength is structural security. One makes you feel safe. The other keeps you stable. And in the next crisis, that distinction may decide everything. Financial crises are not rare events. They are recurring features of history. Empires collapse. Currencies reset. Debt cycles explode. Banks fail. Governments overextend. And every time it happens, one uncomfortable question emerges. Who actually survives intact? Not who panics the least. Not who sounds the smartest. Not who predicted it first. Who walks out stable. Look at 1929. Paper wealth evaporated in months. Fortunes built over decades vanished in weeks. Margin accounts were wiped clean. Gold held value, yes, but the people who survived best were not the ones staring at vaults. They were the ones who owned productive land. Farmers who could feed themselves didn't care what the Dow Jones printed that day. Local craftsmen who repaired tools and machinery were still needed. Communities that traded directly bypassed broken financial channels. Now move forward to 1973. Oil shocks, stagflation, rising prices, falling confidence. Gold surged. But again, who felt inflation the least? Producers, people who controlled resources. If you owned farmland, rising food prices were income. If you had mechanical skill, rising repair costs meant demand. Inflation punishes consumers. It rewards producers. Now look at 2008, a modern, digital, globally connected crisis. Mortgage derivatives collapsed. Interbank lending froze. Confidence vanished. The financial world realized something terrifying. The system depends on trust. When trust breaks, liquidity disappears. But outside financial centers, something fascinating happened. Small local producers kept operating. Farmers still harvested. Local repair shops still worked. Communities that weren't over-leveraged weren't wiped out. They didn't rely on complex financial engineering. They relied on tangible output. And here sits the pattern. The more complex the system, the more fragile it becomes. Modern finance is layered. Banks rely on clearinghouses. Clearinghouses rely on counterparties. Counterparties rely on collateral. Collateral relies on valuation models. It is stability built on abstraction. The Amish system is the opposite. It is stability built on simplicity. Land, tools, labor, community. No derivatives. No leverage pyramids. No exposure to global credit markets. That simplicity isn't set primitive. It's set durable. And durability is the real measure of wealth in uncertain times. Let's take it even further. In every crisis, three groups emerge: speculators, preservers, producers. Speculators try to time volatility. Preservers hold assets like gold to protect value. Producers continue generating value regardless of price movements. The gold investors fall into the second category. The Amish fall into the third. And history consistently shows that producers rebuild the fastest. After wars, it wasn't gold hoarders who reconstructed cities. It was builders. After depressions, it wasn't metal holders who restarted economies. It was farmers and manufacturers. After inflation cycles, it wasn't passive stores of value that restored stability. It was output. Output stabilizes economies. Production rebuilds trust. Work restores structure. And here is the deeper insight most investors miss. The ultimate hedge is not something that rises when fear rises. The ultimate hedge is something that functions when fear disrupts systems. That's what the Amish understand intuitively. They don't need price discovery to validate their wealth. Their wealth is validated daily through function. Milk is produced. Furniture is built. Crops are harvested. Skills are exchanged. They do not measure resilience by portfolio volatility. They measure it by continuity. Can we continue if markets pause? Can we continue if banks tighten? Can we continue if currency fluctuates? Continuity is the true definition of survival wealth. And continuity comes from production, not speculation. Gold is insurance against monetary mismanagement. Production is insurance against systemic instability. And systemic instability is historically more destructive. Empires rarely collapse because gold lost value. They collapse because systems became too fragile to maintain trust. Debt levels rise. Institutions overextend. Confidence erodes. And once confidence fractures, even gold cannot repair the infrastructure underneath. But land still produces, skills still operate, communities still trade. That is why the Amish hedge is not about rejecting gold. It is about prioritizing resilience layers. Gold sits on top of the system. Production sits underneath it. When the top shakes, the bottom matters more. And if you study enough economic history, one pattern becomes undeniable. The quiet producers are rarely the loudest voices during bubbles, but they are almost always the most stable after bursts. That's SEP's not coincidence. That's SEP's structural design. Most people think the Amish are avoiding modern finance. That's SIP's the wrong interpretation. They are not avoiding finance. They are minimizing dependency. And dependency is the hidden risk no portfolio statement shows. When you look at your investments, you see numbers. But behind every number is a chain of energy, a chain of logistics, a chain of law enforcement, a chain of financial clearing systems, a chain of digital infrastructure, a chain of social trust. Modern wealth depends on invisible coordination at a massive scale. The Amish hedge shortens that chain, and the shorter the chain, the stronger the structure. Let's break it down. When you own farmland that produces food, your wealth is tied to sunlight, soil, labor, and seasonal cycles. That system has risk, weather, pests, drought, but it does not depend on Federal Reserve policy, interbank lending markets, corporate earnings reports, international capital flows, algorithmic trading systems. It depends on physical reality. And physical reality is far more stable than financial abstraction. Now think about tools. The Amish invest heavily in durable equipment, not luxury. Durability, a tool that can be repaired, a machine that can operate without fragile supply chains, a system that can function even when parts are scarce. Durability is a financial principle disguised as craftsmanship. Most modern consumers buy efficiency. The Amish prioritize repairability. Efficiency maximizes output in stable times. Repairability maximizes survival in unstable times. That distinction is critical. Modern investors chase maximum return per dollar. The Amish chase maximum continuity per asset. Continuity beats yield during crisis cycles. Now consider community. This is where the hedge becomes even more powerful. The Amish operate in tight-knit economic networks. They trade locally. They extend informal credit. They rely on social accountability rather than institutional enforcement. In modern finance, trust is outsourced to institutions. In Amish systems, trust is internal. That difference matters when institutions fail. Because when banks restrict lending, when governments impose controls, when markets seize up, local trust networks still function. You cannot freeze a handshake agreement. You cannot halt neighbor-to-neighbor exchange with a circuit breaker. And this is where the hedge becomes structural. Gold protects purchasing power, but purchasing power requires access to goods. The Amish hedge ensures access to goods. There is a difference between owning value and controlling production. Ownership can be passive. Control requires participation, and participation builds resilience. Now let's talk about debt. The Amish avoid leverage to a degree that confuses modern economists. In a world where debt amplifies growth, why would anyone avoid it? Because debt amplifies fragility too. Leverage makes prosperity faster. It also makes collapse sharper. The more leveraged a system becomes, the more sensitive it becomes to small disruptions. A minor shock in a leveraged structure can cascade into collapse. We saw it in 2008. Mortgage defaults were not new, but leverage multiplied their impact. The Amish system is under-leveraged by design. Growth is slower, but fragility is lower. And over long time horizons, fragility determines survival more than speed determines expansion. This is something evolutionary biology teaches us clearly. Species that maximize growth without resilience go extinct. Species that balance growth with durability endure. Financial systems follow the same pattern. Now let's examine energy dependency. Modern wealth relies on cheap energy, transportation, data centers, global logistics. The Amish limit that exposure. Their economic footprint is geographically tight. Their production cycles are less dependent on global energy prices. When oil spikes, Wall Street trembles. Local farms adjust. Scale creates vulnerability. Localism creates flexibility. That doesn't mean local systems are superior in prosperity. It means they are superior in continuity. And continuity is what hedging is truly about. Most people misunderstand hedging. They think it means protecting against price declines. But real hedging means protecting against structural disruption. Gold hedges against inflation. The Amish hedge against systemic interruption. Those are not the same risks. Now here's the deeper psychological layer. Gold is passive. It requires no effort. You buy it. You store it. You wait. The Amish hedge requires engagement. You maintain land. You cultivate skill. You strengthen relationships. You produce. Passive wealth can preserve comfort. Active wealth builds capability. And capability is the most undervalued asset in modern finance. Because markets price assets, they don't price resilience correctly. Resilience only becomes visible when systems strain, and by then it's too late to build it cheaply. The Amish don't try to time crises. They structure their lives as if volatility is normal. And historically, volatility is normal. Balloons are temporary. Busts are inevitable. Stability belongs to systems designed for fluctuation. Now imagine two investors. One holds gold in a vault. The other owns productive land, practical skills, and a trusted local network. In a mild inflation cycle, both survive. In a severe systemic freeze, only one continues operating without permission. That's the key phrase, without permission. Modern financial life often requires permission. Bank approval, government approval, market access, digital authentication. The Amish hedge minimizes required permissions, and independence from permission layers is one of the strongest forms of resilience. This isn't set romanticism. It spets structural economics. Complex systems maximize efficiency. Simple systems maximize durability. Financial markets are complex. The Amish economy is simple. When complexity works, it creates abundance. When complexity strains, simplicity outperforms. So the real question becomes, are you hedging for volatility inside the system, or are you hedging for volatility of the system? Because those are different threats. Gold handles the first. The Amish hedge prepares for the second. And history suggests that systemic volatility, though rare, reshapes entire generations. Those prepared for it don't panic. They adapt. They continue. They endure. That is not nostalgia. That is design. Inflation is not just rising prices. Inflation is a transfer mechanism. It transfers purchasing power from savers to borrowers, from wage earners to asset holders, from consumers to producers. And most people never realize which side of that transfer they are on. When inflation begins, it feels subtle. Food costs a little more. Fuel ticks upward. Rent increases slightly. But under the surface, something deeper is happening. Money is losing stability. And when money becomes unstable, the hierarchy of wealth shifts. Consumers suffer first. Every price increase is friction. Every grocery trip is negotiation. Every bill feels heavier. But producers experience inflation differently. If you grow food, higher food prices are not a burden. They extra revenue. If you repair equipment, higher replacement costs increase demand for maintenance. If you build furniture, rising import prices increase the value of local craftsmanship. Inflation punishes dependency. It rewards output. And this is where the Amish hedge becomes dangerous to ignore, because they are not primarily consumers in the system. They are producers within it. They do not rely heavily on distant supply chains. They create value inside their own economic circle. When prices rise nationally, their internal production retains purchasing power. Now let's sectors look at history more closely. In the 1970s, America experienced stagflation, high inflation, low growth, weak confidence. Gold surged. Yes, but something else happened quietly. Farmland values exploded. Why? Because farmland produces food, and food becomes more valuable during inflationary pressure. Farmers weren't set just preserving value. They were compounding it. Inflation made their output more powerful. Now, fast forward to modern times. Supply chain shocks, pandemics, energy disruptions. What happened? Those who controlled tangible production, food, energy, local repair, gained leverage. Supermarkets emptied. But farms didn't disappear. Imported goods stalled. But local workshops continued. When inflation collides with scarcity, and ownership of production becomes leverage. Gold protects you from currency weakness. Production protects you from scarcity. Scarcity is far more destabilizing. Now here sits the uncomfortable part. Modern financial advice often focuses on diversifying portfolios, stocks, bonds, real estate, commodities. But diversification within financial markets is not the same as diversification of capability. If all your assets depend on the same monetary infrastructure, you are diversified in price exposure, but concentrated in systemic exposure. Inflation exposes that concentration. Because inflation is rarely isolated, its spets usually accompanied by policy reaction, interest rate hikes, liquidity tightening, credit restrictions. When central banks fight inflation, they often damage financial markets. Stocks fall, bonds fall, housing slows, and suddenly paper diversification shrinks. But production doesn't shrink as easily. If people need food, food retains demand. If machines break, repair retains demand. If shelter is scarce, construction retains demand. Production adjusts to inflation. Financial assets react to inflation. Reaction is defensive. Adjustment is adaptive. And adaptability is stronger. Now think about psychological stability. Inflation creates anxiety. Savings erode. Confidence fades. News cycles amplify fear. But a producer sees something different. They see rising input costs. Yes, but they also see rising output prices. They operate within the storm instead of watching it from the outside. That mental positioning matters, because economic crises are not just financial events. They are emotional events. And those who control output feel less powerless. The powerlessness fuels panic. Production fuels control. Now let's examine something even deeper. Inflation is rarely accidental. It is often the consequence of excessive debt. When governments accumulate large debts, inflation becomes politically convenient. It reduces the real burden of repayment. It erodes savings quietly. It taxes holders of currency without legislation. In that environment, holding passive monetary hedges may protect some value, but controlling tangible output protects autonomy. Autonomy is the hidden advantage of the Amish hedge. When you can produce, you negotiate from strength. When you can repair, you don't panic at shortages. When you can grow, you are less vulnerable to supply interruptions. Autonomy changes your position in inflation cycles. You move from being squeezed to being sought after. And here's where this becomes uncomfortable for modern investors. The more urbanized and specialized society becomes, the more dependent it becomes on distant systems. Urban living is efficient, but efficiency reduces redundancy. Redundancy is expensive, but it is resilience. The Amish system includes redundancy by design. Multiple families produce similar goods. Skills are shared across generations. Knowledge is not outsourced to digital platforms. Inflation disrupts fragile efficiency. It strengthens resilient redundancy. Now ask yourself honestly, if inflation accelerated sharply tomorrow, would you be primarily paying higher prices or charging them? That question reveals your position in the transfer, because inflation always transfers. It doesn't destroy wealth evenly, it shifts it. Gold helps you resist the shift. Production allows you to benefit from it. That sets a different tier of positioning. Now let's zoom out. Inflation is not rare. Currency debasement is not rare. Monetary resets are not rare. Throughout history, paper systems expand, confidence peaks, debt rises, and then adjustment comes. The winners are rarely those holding the most symbolic wealth. They are those controlling necessary output. Grain during Rome, land during medieval transitions, industry during Reconstruction eras, energy during oil shocks, food during supply crises. Necessity compounds when money weakens, and necessity is the foundation of the Amish Hedge. It is not anti-modern, it is structurally layered. Gold protects monetary value, production protects economic position, and economic position determines who absorbs inflation and who benefits from it. So the real question isn't should I own gold? It sets, am I positioned as a consumer or a producer when instability rises? Because inflation is not just higher prices, it is a reordering of power. And those prepared for that reordering rarely panic. They adapt, they gain, they endure. Modern wealth feels solid. You log into your brokerage account. You see 6 figures, maybe 7. You own stocks, ETFs, retirement accounts, crypto, real estate investment trusts. On paper, you stare diversified. On paper, you secure. But here is the quiet truth. Most modern wealth is conditional. It exists within systems you do not control. Your portfolio depends on the clearinghouses, custodians, exchanges, banking rails, government policy, electricity, internet infrastructure, legal enforcement. Every layer works until one layer doesn't set. And when one layer fractures, access becomes uncertain. Notice the word access. The greatest illusion in modern finance is ownership. You believe you own an asset, but in reality, you own a claim inside a system. A claim that depends on rules. Rules that can change. Let's examine history carefully. In 1933, the US government made private gold ownership illegal. Overnight, legality shifted. In Cyprus, in 2013, bank depositors woke up to bail-ins. Their deposits were partially seized to stabilize the banking system. In 2020, entire global economies were paused by policy decision. Businesses shut down, travel halted, movement restricted. Markets survived, but they did not operate normally. And during every crisis, one thing becomes clear. Liquidity is not guaranteed. Access is not guaranteed. Permission is not guaranteed. Your brokerage account may show wealth, but if exchanges suspend trading, if capital controls are implemented, if withdrawal limits are imposed, your ownership becomes theoretical. The Amish Hedge does not depend on digital custody. If you own land, you don't log in to confirm it exists. If you own livestock, you don't refresh a screen to check its value. If you possess skill, no regulator can freeze it. That is a different category of ownership. It is direct. It is tangible. It is immediate. Now let's go deeper. Modern wealth is highly centralized. Most global assets are tied to a handful of major financial institutions. Clearing is centralized. Settlement is centralized. Custody is centralized. Energy grids are centralized. Payment systems are centralized. Centralization increases efficiency, but it also increases systemic risk. If a decentralized network loses one node, it continues operating. If a centralized hub fails, everything connected to it trembles. This is not theory. This is engineering, and finance is engineering layered over trust. The more interconnected a system becomes, the more sensitive it becomes to shocks. We call this systemic fragility. And fragility is invisible during stability. When markets are calm, digital wealth feels permanent. When volatility spikes, fragility reveals itself. Now consider something even more subtle. Modern investors are trained to think in terms of returns, quarterly performance, annual yield, compound growth. Very few think in terms of continuity. Can this asset function if systems strain? Can this wealth be accessed without intermediaries? Can this ownership survive regulatory shifts? These are not questions discussed during bull markets. They only emerge when panic surfaces. Gold partially escapes digital fragility, but even gold relies on storage systems, transport channels, and exchange markets for full liquidity. And in extreme environments, liquidity is everything. If you cannot trade, your hedge is immobilized. The Amish hedge operates differently. Its liquidity is embedded in function. If you grow food, its value is immediate. If you repair tools, its demand is immediate. If you build shelter, its utility is immediate. It does not require an exchange floor. It does not require price discovery. It does not require investor sentiment. It requires need. Need is the purest form of economic demand, and need does not collapse when markets do. Now let's confront something uncomfortable. Most people believe the greatest risk is losing value, but historically, the greater danger has often been losing access. During hyperinflation in Weimar Germany, people had money. It simply lost value rapidly. During banking freezes, people had deposits. They couldn't withdraw them. During wartime disruptions, people owned assets. They couldn't trade them freely. Ownership without access is trapped wealth, and trapped wealth cannot protect you. The Amish hedge minimizes trapped wealth risk. Its assets are usable without system permission. You don't need a brokerage statement to milk a cow. You don't need a clearinghouse to plant crops. You don't need a bank wire to repair equipment. Function replaces permission. Now let's analyze the psychological shift. Digital wealth encourages detachment. You outsource production. You outsource repair. You outsource community. You outsource food. You outsource energy. Your wealth becomes a claim on others. Output. That works beautifully in stable systems. But if systems strain, claims compete. And when claims compete under stress, priority shifts. Who gets energy? Who gets supply? Who gets liquidity? Complex systems prioritize strategically important nodes. Individuals rarely sit at the top of that list. The Amish hedge reduces competition for priority because it lowers dependence on centralized allocation. This is not anti-modern thinking. It is layered thinking. Modern wealth is powerful. It creates enormous prosperity, but it is also layered atop fragile infrastructure. True hedging acknowledges that fragility and builds beneath it. Imagine a skyscraper, beautiful, efficient, profitable, but built on soft soil. It may stand for years, but if pressure builds beneath it, the foundation matters more than the glass exterior. Financial portfolios are the glass. Production capacity is the foundation. Gold reinforces the glass. The Amish hedge reinforces the soil. Now here's the key insight. The future will likely include more volatility, not less. Debt levels are historically high. Global supply chains are stretched. Geopolitical tension is rising. Energy transitions are underway. Digital systems are increasingly targeted. Complexity is increasing, and complexity increases fragility. That does not mean collapse is imminent. It means volatility cycles will likely intensify, and during intensified cycles, layered resilience becomes critical. Gold is a monetary hedge. Stocks are a growth hedge. Bonds are a yield hedge. The Amish hedge is a continuity hedge. Continuity is rarely discussed, but continuity is everything during stress. Because if you can continue operating while others pause, you gain leverage. If you can continue producing while others wait for permission, you gain independence. And independence is not ideological. It is structural. It is the difference between owning a claim and owning capability. So the deeper question becomes, is your wealth entirely dependent on complex coordination, or do you control something that functions even when coordination strains? Because in every crisis in history, those who controlled production stabilized faster. Those who relied entirely on abstraction waited. And waiting is expensive during volatility. You don't need to reject technology. You don't need to abandon markets. You don't need to move off-grid. That's not the lesson. The lesson is layering. The modern investor makes one critical mistake. They build vertically, income saving financial asset retirement. It sumps a single tower. If the financial layer shakes, the whole tower vibrates. The Amish build horizontally: land, skill, community, tools, low leverage, production. Each layer supports the others. If one weakens, the system continues. So how do you build a horizontal hedge in a vertical world? First, you redefine wealth. Wealth is not net worth. Wealth is controlled capability. Controlled capability means, what can you produce? What can you repair? What can you trade? What can you operate without permission? If the answer is nothing, you are entirely dependent. And dependence is profitable in stable eras, but dangerous in unstable ones. Now let's break this into real-world layers. Layer 1, monetary hedge. Yes, gold still matters. Currency debasement is real. Debt cycles are real. Central bank expansion is real. Gold protects purchasing power inside monetary instability. But gold should not be your foundation. It is your monetary insurance. Insurance is not the house. It protects the house. Layer 2, productive assets. This is where most portfolios are empty. Productive assets are not just dividend stocks. They are tangible systems that generate output regardless of financial sentiment. Examples: farmland or agricultural exposure, energy production capacity, rental property in functional markets, equipment that produces income, tools that create value. But here is the nuance. Not all productive assets are equal. A rental property dependent on high leverage and short-term credit is fragile production. A debt-light property in a stable area is durable production. Debt amplifies output, but also risk. The Amish understand this deeply. They expand slowly. They avoid fragility. They prioritize control over speed. Modern investors prioritize speed over control. Control is more valuable during volatility. Layer 3, skills. This is the most overlooked hedge in existence. Skills cannot be inflated away. They cannot be frozen. They cannot be seized digitally. They cannot be diluted. If you can build, repair, diagnose, grow, teach, or adapt, you hold portable wealth. In every crisis in history, skilled individuals regained stability faster. During depressions, mechanics worked. During wars, engineers rebuilt. During inflation, tradespeople charged more. Skill is anti-fragile. It strengthens when systems strain. Now ask yourself honestly, if your job vanished tomorrow, Could you generate income outside corporate systems? If the answer is no, your wealth is conditional. The Amish Hedge embeds skill into daily life. It is generational. Children grow up learning productive capability. Modern society outsources skill to specialists. Convenience rises. Capability declines. Convenience feels rich. Capability is rich. Layer 4. Community capital. This one is uncomfortable for modern individualists. Community is leverage. The Amish operate in dense trust networks. They share labor. They extend credit informally. They rebuild collectively. Modern life is fragmented. Neighbors often don't know each other. Economic exchange is anonymous. Trust is outsourced to institutions, but institutions are brittle under strain. Communities are adaptive. During natural disasters, it is neighbors who stabilize first. During blackouts, it is local networks that share resources. Community reduces friction during crisis, and friction determines survival speed. You cannot buy community overnight. It must be built slowly. Layer 5. Low complexity living. Complex systems fail faster under stress. The more fixed expenses you carry, the more subscriptions, the more debt obligations, the more lifestyle inflation, the more fragile your position. The Amish Hedge reduces fixed fragility, low debt, durable assets, long-term thinking. They sacrifice speed for endurance. Modern culture rewards speed, but endurance wins long cycles. And economic history is a series of long cycles. Now here's the deeper strategic insight. You are not preparing for collapse. You are preparing for volatility. Collapse is rare. Volatility is guaranteed. Volatility tests leverage. Volatility tests liquidity. Volatility tests confidence. If your system requires everything to go right, it is fragile. If your system can absorb shocks, it is resilient. The goal is not paranoia, it is optionality. Optionality means you can operate under multiple conditions. Markets booming, you participate. Markets slowing, you continue producing. Currency weakening, your assets adjust. Supply chains tightening, you are less dependent. Optionality is freedom, and freedom compounds. Now let's confront something very real. Modern financial media focuses on maximizing returns. But maximizing returns often requires maximizing exposure. Exposure to credit, exposure to markets, exposure to policy. Exposure creates upside. It also creates synchronization. When synchronized systems fall, they fall together. That's why in 2008, almost everything dropped at once. Correlations rise during crisis. Diversification collapses. But productive capability doesn't correlate with stock indexes. It correlates with necessity. Necessity is stable demand. Now imagine two futures. Future A. You hold stocks, bonds, and gold. You rely entirely on financial liquidity. Your income depends on corporate stability. Future B. You hold stocks and gold. But you also control productive assets. You possess transferable skills. You operate in a trusted network. You carry low fragility. Which future handles volatility better? Future B does not eliminate risk. It reduces dependency layers. And dependency layers are where fragility hides. The Amish Hedge is not anti-investment. It is anti-fragility. It acknowledges a simple truth. Complex systems expand until they strain. Debt expands until it constrains. Efficiency expands until it breaks. And those who survive best are rarely the most leveraged. They are the most layered. Now ask yourself one final question. If markets closed for 90 days, would your life freeze or would it continue? That question reveals your exposure. Gold helps in monetary storms, but layered production helps in structural storms. And structural storms are the ones that reshape decades. This is not about abandoning gold. It is about understanding hierarchy. Monetary hedge first, production second, skill third, community fourth, low fragility always. The Amish don't call it a hedge. They call it life. And maybe that's why it works. Most investors think in cycles, quarterly earnings, annual returns, 5-year outlooks. But economic history doesn't move in quarters. It moves in eras, debt eras, expansion eras, inflation eras, reset eras. And when an era shifts, the rules that worked for 20 years can stop working almost overnight. The uncomfortable reality. We are likely entering a long transition era. High global debt, aging demographics, energy transition pressure, rising geopolitical fragmentation, currency competition, digital system concentration. This doesn't guarantee collapse. It guarantees volatility. And volatility over long stretches punishes fragility more than it punishes ignorance. The next 30 years will likely reward resilience more than speed. That's where the Amish hedge becomes strategic, not romantic. Let's step back. Gold protects you from monetary erosion. Stocks grow with economic expansion. Bonds smooth yield cycles. But none of those alone protect you from structural transformation. Structural transformation is when supply chains reconfigure, trade blocks fragment, currency dominance shifts, energy systems evolve, political priorities change. These shifts don't destroy wealth instantly. They slowly reprice it, and when repricing happens, those who control tangible production and capability reposition fastest. The Amish don't store forecast macroeconomic policy. They structure around uncertainty. That is the deeper lesson. They assume volatility is normal. Modern investors assume stability is default, and assumptions determine positioning. Now imagine the next 3 decades unfold like this. Repeated inflation waves, periods of monetary tightening, asset bubbles followed by contractions, increasing digitization of finance, greater regulatory oversight, periodic liquidity shocks. In that world, leveraged growth strategies become unstable, but layered resilience compounds quietly. Let's define layered resilience clearly. Layer 1. Monetary shield. You hold gold or hard assets to buffer currency instability. Layer 2. Market participation. You own productive businesses or equity to benefit from expansion. Layer 3. Tangible output. You control some form of real-world production. Layer 4. Human capital. Your skills are adaptive and transferable. Layer 5. Network capital. You operate within trusted local or professional systems. Layer 6. Low fragility. Your lifestyle does not require perfect conditions to sustain itself. Most investors operate at Layer 1 and 2. Very few intentionally build Layer 3 and beyond. That sips the asymmetry. And asymmetry is where advantage hides. Because when volatility hits, those with deeper layers don't scramble, they adjust. Adjustment speed determines long-term survival. Now let's talk about compounding differently. We think of compounding as financial growth, but resilience compounds too. Skills deepen over time. Community strengthens over time. Debt reduces over time. Durable assets appreciate through use and scarcity. And here's the paradox. Resilience feels slower in bull markets. It feels smarter in bear markets. During economic booms, leverage outperforms discipline. During contractions, discipline outperforms leverage. The Amish hedge prioritizes discipline, slow expansion, low debt, high durability, skill accumulation. This is not exciting. It is stable, and stability is undervalued during expansion eras. But over 30-year horizons, stability wins more often than speculation. Now here's something critical. The next era will likely test digital concentration. Finance is increasingly digitized. Currency may become programmable. Access may become conditional on compliance structures. This is not conspiracy. It is observable policy trajectory. Digital systems increase efficiency and oversight, but they also increase central control. And central control reduces flexibility during stress. If financial access becomes more regulated, more conditional, more monitored, owning tangible, local, productive capability becomes even more valuable because it operates below macro-regulatory noise. You don't need regulatory approval to grow food. You don't need algorithmic validation to repair equipment. You don't need a digital ledger to teach skill. This does not mean rejecting modern systems. It means not depending exclusively on them. Dependency concentration is fragility. Now zoom out further. Throughout history, wealth transitions from abstract to tangible during instability. After bubbles burst, investors flock back to cash flow and necessity. After speculative mania, fundamentals matter again. The Amish hedge is permanently fundamental. It doesn't need revaluation. It produces daily. And production is time-tested wealth. Now imagine you stare looking back from 2055. Two investors started in 2025. Investor A maximized exposure to high-growth assets, heavy leverage, and financial yield. Investor B participated in markets, but built layered resilience. Over 3 decades of volatility, which one sleeps better? Which one avoids forced selling during downturns? Which one negotiates from strength during inflation spikes? Which one can wait out asset repricing without panic? The answer is not theoretical. It's structural. Resilience reduces forced decisions. Forced decisions destroy wealth. Most losses happen under pressure. The Amish hedge reduces pressure. Pressure comes from high debt, high fixed costs, single income dependency, full system reliance, no fallback capability. Reduce pressure, reduce panic, preserve capital, compound patiently. Now let's confront the biggest misconception. This is not about preparing for apocalypse. It is about preparing for stress cycles. Stress cycles are normal. The 20th and 21st centuries were not smooth. They were turbulent. Wars, inflation, depression, currency resets, oil shocks, financial crises, pandemics. And yet, those with layered systems endured. The Amish have survived industrialization, world wars, the Great Depression, the 1970s inflation, modern globalization, not by predicting markets, but by structuring independence. Independence is long volatility insurance. The next 30 years may bring energy restructuring, supply chain rebalancing, debt monetization, regionalization of trade, technological displacement. These shifts reward adaptability. Adaptability requires capability. Capability requires intentional design. So here is the ultimate framework. Do not replace gold with the Amish hedge. Layer them. Gold protects currency. Markets grow capital. Production anchors stability. Skills create optionality. Community reduces friction. Low fragility prevents collapse. That is the hierarchy. The modern mistake is overconcentration at the top. The Amish model reinforces the base. Strong bases outlast volatile peaks. And over 30 years, outlasting matters more than outperforming. Because the investor who survives every cycle participates in every recovery. The investor who collapses during one severe downturn never compounds again. Survival is underrated. Continuity is underrated. Durability is underrated. But history rewards all three. So before you buy another ounce of gold, ask yourself something deeper. If the next era is unstable, am I positioned to preserve purchasing power or to preserve independence? Because independence compounds across generations. And that may be the real hedge. For centuries, investors have searched for the perfect safe haven: gold, silver, land, stocks, bonds. Every era crowns something as the answer. But history teaches a quieter lesson. No single asset survives every storm the same way. What survives is structure. Gold protects against monetary weakness. Markets reward innovation, but the deepest form of protection has always been the same: the ability to continue producing, continue trading, continue adapting, continue without asking permission. The Amish never framed it as a hedge. They framed it as life: low debt, high skill, strong community, durable assets, production over speculation. And because of that, they don't panic during cycles. They adjust. When inflation rises, they produce. When markets fall, they continue. When systems strain, they operate. That's SEP's not ideology. That's SEP's design. The real risk in modern finance isn't set volatility. It's bets dependency. Dependency on perfect liquidity. Dependency on uninterrupted systems. Dependency on centralized trust. Gold reduces currency risk, but independence reduces structural risk. And structural risk is what reshapes generations. So this isn't set about rejecting gold. It's SEP's about hierarchy. Own monetary protection, but build beneath it. Because when the next cycle tests confidence, and it will, the question won't just be, how much did my hedge rise? The question will be, can my life function under pressure? If the answer is yes, USB built something deeper than wealth. USB built resilience, and resilience compounds longer than any bull market ever will.